The global world order is shifting. New alliances are forming, and tensions between global powers are on the rise. And in the middle of it sits one of the most sought-after commodities, oil. From military conflicts to supply shortages and price manipulation, the New World Order risks leading to unprecedented volatility in the oil market. We're going to dive into the impact of this shifting landscape on oil supply and demand, and ultimately, what's the most likely scenario for oil in the short term. On the supply front, the situation seems troubling. Russian oil exports to the West were completely cut off in 2022 as a result of the war in Ukraine. This, of course, led to a big initial jump in oil's price in 2022. But with the ongoing war in Ukraine, there's no sign that European or American imports of Russian oil are likely to pick up anytime soon. And we're also seeing OPEC oil production move down. OPEC makes up about 40% of the world's oil production today. And since 2018, we've seen their production of oil move steadily lower for the longest period since the 1980s, a period known for spikes in oil prices. If Russia and OPEC members, that together represent over 50% of the world's oil supply, are determined to cut their supply of oil to the rest of the world, it could lead to oil shortages, more easily driving the price of oil significantly higher. A great example occurred following the Iranian Revolution in 1979. Iranian oil was entirely cut off from the Western world, causing oil prices to triple instantaneously. With rising tensions and many nations reducing their oil supply, it's only normal to worry about a similar oil shock occurring today. For a similar situation to happen today, Western powers would need to be completely cut off from all Middle Eastern oil, including Saudi Arabia, the UAE, Kuwait, Iraq, and Qatar. Such a complete cutoff from Middle Eastern oil seems unlikely today. We've also seen the United States and Canada ramp up their own oil production. Over the last couple of decades, the US and Canada have tripled their oil production capacity. The US and Canada now produce about as much oil as Saudi Arabia and Russia combined. So while there are some reasons for concern on the supply front, it seems that the West is a little bit more insulated from major supply shocks than it has been in the past. Most of the fluctuations in oil prices can be attributed to changes in global demand rather than supply constraints. Let's take a look at that. Many believe that lower demand for oil is going to drag the price lower. One theory is that renewable energy will gradually replace oil as our main source of energy. Many believe that the rise of renewable energy will lead to a decrease in demand for oil. Indeed, since the 1970s, the share of oil in global energy consumption has steadily declined, and we've seen an acceleration in the adoption of renewables, such as solar or wind power in the last decade. However, these are relative measures, which do not reflect the total increase in global energy consumption. When we adjust this chart so that it takes into account the total increase in global energy consumption over time, we see that total demand for oil has actually significantly increased since the 1970s. And we can argue there's still substantial room for growth in oil demand as emerging economies continue to drive up demand for oil. India's oil demand, for example, has grown at an extremely rapid pace since the 1970s, seeing its consumption rise to 6 times more elevated levels today than what it was in 1980. But it is still just a fraction of that of the United States. As India continues to develop and industrialize, it's reasonable to expect that India's oil consumption will continue to rise and catch up with developed economies. Same for China. It has seen its oil consumption go from about a fifth of that of the United States in the late 1990s to representing about 15% of global oil consumption today. But again, China's oil consumption could still move substantially higher from here, as it has a population size 5 times larger than that of the United States. As developing countries continue to catch up to the West, their energy needs will likely increase and further drive up demand for oil. Unless there's an unprecedented surge in renewable energy adoption over the next few decades, we can expect sustained upward pressure on oil demand in the long term, which could potentially drive oil prices higher. However, these are very long-term trends and are unlikely to impact oil prices in the short term. In the short term, oil prices are closely tied to U.S. manufacturing economic activity. This is the ISM Manufacturing PMI, and it shows the level of manufacturing activity in the U.S. When we add the price of oil, we see that there is a very strong relationship between the two. The next big move in manufacturing data will likely determine what oil prices do in the medium term. In 2008 and 2020, recessions occurred. Manufacturing activity grinded to a halt, which caused oil prices to move down substantially. Whether or not the global economy will experience a recession in 2025 is a topic that's hotly debated and will be the determinant factor for whether oil's price can resume higher or not. From a technical analysis perspective, there's no clear sense of direction based on moving averages. When the price of oil hovers around its moving averages without a clear upward or downward movement, it shows the market is uncertain of direction. We can see a pattern of lower highs and higher lows, known as contraction price action. Such a setup is often followed by a significant breakout in either direction as the market builds up energy for a substantial move. Traders wishing to trade oil can wait for a breakout in either direction before initiating a trade. To manage risk, always use a stop loss, placing them just below the lower trend line for long positions and just above the upper trend line for short positions. This limits potential losses if the breakout fails. If you're looking to take advantage of the market and trade oil or other commodities, open an account at Capital.com today.